In this video, we are going to continue in Chapter 15 talking about the role of expectations on our macroeconomic variables. So last time we talked about the role that expectations play in consumption. We talked about that some individuals will think about their sort of lifetime wealth, their lifetime earnings when deciding how much to consume, although that's not always possible even for the most sort of foresighted, rational individual. Here we're going to talk about the role of expectations and investment. And so when we think about investment, we are talking about purchasing capital goods, so goods that are going to help us provide more goods and services. And so if we think about, purchasing, say, a machine, we want to think about, okay, well, what is the present value of expected profits in order to see, whether or not we should even buy the machine in the first place, right? And in order to do that, we need to think about both the sort of real, if we're thinking about real profits and real present value, discounted present value, then we need to use the real interest rate, but we also need to think about how long the machine will last, right? So we can think about how much it depreciates every year, which we called delta. So if the machine depreciates at a rate delta, and the real interest rate is R, then expected profits next year are just going to be 1 over 1 plus R, right? We can assume that it hasn't depreciated in that first year. And then in the next year, it will be 1 minus delta times whatever the expected profits are, divided by 1 plus R times 1 plus R t plus 1, right, an expected value. And so that will go on for however long we think the machine will last, right? So that's going to depend on delta, and of course it could depend on a number of business, issues. We might think, okay, well, this machine will be good for 10 years, and then even if it has some value, technology might be such that we would want to replace it anyway. So then the investment function becomes a function of these expected future profits, right? And these expected future profits are dependent on the depreciation rate and on the real interest rates. So if we think about this in the same way that we thought about the present discounted value of bonds and stocks, then we can say, okay, well, the present value in year T, for this level of profits, pi, this is just a capital pi here, E t plus 1, is just 1 over 1 plus RT times that value. And in year 2, then we have to discount it also by the depreciation, so it's 1 minus delta times whatever we expect profits to be, and then put in both discount factors, 1 plus RT and 1 plus RE t plus 1. And so this will give us an idea, excuse me, of how much that machine is going to be worth over its lifetime, and therefore how much we would like to pay or are willing to pay for that machine today. So when we think about investment and the stock market, one useful sort of ratio is Tobins Q. And it's Q just because that's what he chose to call it in the paper. It's the ratio of the value of capital relative to its current purchase price. And so a higher Q leads to higher investment. And so what we have is we have the change in Tobins Q in this red line. That's on the right-hand axis. It's lagged 1 year. And then we have the change in the ratio of investment to capital. So how much are we investing relative to the capital stock? And the blue line, that's on the left-hand axis. And you can see that Tobins Q and investment tend to go up together, at least lagged 1 year. So they tend to be high together, they tend to be low together, although it's obviously also not a perfect correlation, right? There are a few years here where one is going up while the other is going down. So that's just one way to think about it. All right, so now if we think about expectations and interest rates and investment, and we assume that profits are expected to be equal each year, so we'll just call them capital pi sub t, and we expect real interest rates to be constant, we'll call them RT, and we expect depreciation to be constant, which we call delta, then the present discounted value of expected profits is just capital pi t over RT plus delta, right? This is very similar to the Z over I that we had in chapter 14, because the pi t is the payments that we expect to get every year, right? We call that Z in chapter 14. And then the discount factor, which was just I, or 1 plus I, which we had in chapter 14, is now RT plus delta. And so now we can say, okay, well, investment is some function of profits divided by RT plus delta, where RT is the real interest rate and delta is depreciation. And together, we call RT plus delta the rental cost or shadow cost of capital, right? Because it's what you give up by buying your capital, because it's you give up the real interest rate because you could have just bought, say bonds, and you give up depreciation because that's how much wears out every year. So if that's an accurate picture of investment, then investment depends on the ratio of profit to the user cost, right? So we have profit in the numerator and the shadow cost, RT plus delta, in the denominator. So more profit equals more investment, and more cost, higher cost, leads to lower investment. So higher interest rates, higher depreciation leads to lower investments. Now, if current profit is low, right, then it won't be able to, invest in the physical capital it needs unless it can borrow, either through a bank or through bonds. And it might have difficulty borrowing, right? It depends on, how well financial markets are working, how profitable it has been in the past, what expectations are for the future, etc. And so in general, as we see, we think that actual investment does depend positively on current profits. And so here we see the change in profit in the right side axis in red, and the change in investment on the blue axis, on the left-hand axis in blue. And you can see that usually when profits are higher, investment is higher. And they tend to move together. So investment really seems to depend not only on sort of future expected profits, but also current profits, because with current profits, you don't have to borrow. And so this is where it's important to sort of keep clear the difference between profitability and cash flow, right? Profitability is all about, the present discounted value of future profits, which is revenue minus costs. Cash flow is how much cash the firm is receiving minus how much it has to pay out, right? So it's the net flow of cash. And so one economist found that, declines in the oil price led to large losses in oil-related activities, and investment spending in non-oil activities also were reduced, right? So because they had less profit from these oil-related activities, they also had to invest less in these other activities. And so cash flow is important for investment, right? How much cash does a firm have, where they can make these investment decisions very easily because they can just spend the cash that they already have.